the
Madhu, you're breaking up.
floor is yours. Please
I'm
go
not
ahead.
hearing properly.
Thank you, Madhu. Assalamu alaikum and Ramadan Kareem to everyone. Welcome everyone to the earnings presentation for our fourth quarter and full year 2025 results. My name is Muhammad bin Khalid. I'm the head of investor relations at Jamjoom Pharma. I'm joined by Dr. Tariq Husni, the CEO, and Mr. Anwar Mohiuddin, the CFO. The call is 1 hour long with a 20-minute management presentation followed by 40 minutes for Q&A. Over to you, Dr. Tariq.
Thank you, Muhammad. Assalamu alaikum all. And inshallah, Ramadan Kareem to all of you. And inshallah, Shahr Mubarak. It's a great pleasure to share with you our results for 2025. Another strong year, as you all, I'm sure, would expect. We cannot disappoint you. It's another very strong year where Jamjoom Pharma keeps on imprinting one strong milestone after the other. So we'll start with some of the highlights of our results. On the revenue side, we closed the year at 1.5 billion. If you remember, not so far away, just a couple of years ago, we closed the first 1 billion Saudi Riyal for Jamjoom Pharma in its history. And now we're coming 2 years after, and we're delivering another 500 million on the top of this. So 1.5 billion revenue was 14% year-on-year growth. The EBITDA is 8 points ahead of the growth on the revenue, 22%, another 8% or another 8 points ahead on the net profit, 30% growth year-on-year on the net profit. EBITDA at 35.5% and the net profit at 31%, which is basically, as I would always remind you, it's results that are mimicking big pharma and big multinationals as opposed to domestic and regional players. The numbers of brands keep on expanding. We launched about 7 or 8 in 2025. Our free cash flow is as strong as ever, with close to 460 million free cash convert, and the units produced basically similar to what we produced in 24, a little bit lower, which we're acting smarter, as I shared with you. In 2025, we are selling higher value products and focusing on more strategic brands that boost more the top and the bottom line. Next slide, please. So that's basically it. I feel like it was just a few months ago when I joined, basically April 2021. Times passes like crazy. So in 2021, we closed the year at 736 million. Here we are 4 years afterwards, and we are more than doubling this revenue at 1.5 billion. So more than doubling the revenue, and with 20% CAGR, or 19.5 to be exact. Next slide, Muhammad. While when you look at the same period for the EBITDA and the net profit, you see even more appealing and stronger growth. So 25.5% CAGR on the EBITDA from 21 to 25, and on the net profit, 28.4% CAGR. So we have almost, as you can see on the right-hand side portion of the slide, we have almost tripled the bottom line. So our key highlight in 4 years post 2021, we more than doubled the top line and almost tripled the bottom line, which is a phenomenal performance, as you would hopefully all agree with us. Next slide. So some of the highlights on the 2025 performance. If we focus on our inception market, the KSA market, again, I'm very pleased to report that we closed the year at one of our highest performance, not only from revenue and bottom line point of view, as I shared with you, but definitely that's translated into our rank and our position in the market. So we ranked second for the first time in Jamjoom Pharma history. Although in the first 11 months we were first, and we came second on the last months, just by 15 million difference between us and number one, which is a great performance for Jamjoom Pharma. And we gained almost 0.7% market share. So we moved from 5.6 to 6.3 share on the retail market that constitutes 65% of the Saudi total pharmaceutical. On the total market of Saudi Arabia, including institution and tender, we came as the fourth player, moving from number 7 in 24 and from number 10 or 11 in 21. So we jumped like 7 ranks in 4 years and 3 ranks in 1 year on the total market, with a 4.5% market share and 18% again. Again, a very, very strong performance that we are proud of in our key inception market. Other markets are not performing any weaker. As a matter of fact, Iraq is growing at 13%. Gulf is growing at 10%, with some issues that we had in some of the small markets there, but really solid performance in the Gulf, ahead of the market growth as well. Egypt in local currency grew at almost 22%, and in constant currency 5%, and the other markets in North Africa and others are 15% growth in 2025. From a portfolio point of view, we definitely continue to drive our cardiometabolic, led by the antidiabetic portfolio, as you will see in the coming slide. So 25% in this therapy area. We launched 6 products, as mentioned earlier. And we have as well a very strong pipeline, as I'm going to share with you in the coming slides. As well, I'm going to share our business development initiatives, where we have signed and finalized almost 16 key strategic deals across high-value therapy areas, which definitely give us a very strong foundation and strong confidence in our future growth. Manufacturing, as you will see, maybe we'll move to the next slide, Muhammad, so that we can show it in better details. On the manufacturing side, as you can see, in Jeddah is almost where we were a couple of years ago, or a year and a half ago, to be more exact, working hand to mouth. Today we are at least breathing there, and we reduced the capacity their utilization to the high 80s, early 90s throughout the year, which is a good place to be. In the new sterile facility in Jeddah, our jewel on the crown, we have almost reached 8.5 million out of a 20 million capacity ability in this facility. So it's almost, we're operating at close to 35% there. Egypt, while we are at 60% of the capacity, we are satisfying the local market by almost 97, 98% of its needs, which is a great place to be, and moving within our plans and expectations. And the next definitely thrust for this facility is to look for markets that we are going to explore to send them goods from the Egyptian facility, like the African markets, the neighboring markets, Libya and Sudan, and the likes of such markets. Algeria, the oral solid form that we acquired from Novartis a couple of years ago, as you remember, or almost a year and a half ago, 15 million capacity, and we are operating today at 12.5 million, mostly production for the Novartis tail products that are still with us from a production as well as distribution point of view. Moving to next slide. Yeah. Here you see the consistent growth across all our therapy areas, as well as we'll talk about key markets and the drivers of such growth in 2025. So on the left-hand side, you see that OFSA and Derma continue to grow strongly, 8 and 6%. Of course, we are reaching some maturity in these areas, but still they are performing very well. And don't forget, this is only shipment move and migration. But when you look at, for example, our data in Saudi, OFSA is growing beyond 20% and above the market growth, which is about 16% of the therapy area. The same for Derma and all our other therapy areas. You can see anti-diabetic 40%, very strong growth boosted by the products that we launched in 24 and 23, as well as the one or two new products that we launched in 25. Cardiovascular 21%, and pain and inflammation and central nervous system at almost 9 and 12%. When you look at market by market growth driving, Saudi Arabia continue to perform strongly, 15% growth, while almost close to 60% growth at the institution and tender business there. Gulf, as I mentioned to you, 10%, Iraq 13%, and then you look at Egypt, 22% in constant or local currency and 5% in constant currency. And then markets of North Africa are growing at 15%, driven by Morocco and some other export markets. Very refreshing to see that the growth contributors are basically 62% driven by strategic brands. So it shows us that our strategy in action or in motion is really delivering dividends, and we are really moving within the strategy that we set to our team and ourselves. Strategic brands are driving our growth. Established are still contributing by 15% to this growth, and new products are contributing by 23% to such growth. So very nice picture, strategically compelling for me that the team is taking what we are sharing with them from a strategy, and they go and they execute with excellence to help us with such phenomenal performance. Next slide. That's a slide that I'm sharing with you almost now for 4 years, as the title entails. So we're coming close to 50 months here or more. And as you can see, Jamjoom Pharma among its peers. I think you became familiar with these slides. Only 2 red areas or red months out of the 48 months, while the 4 other top players in the marketplace, the least is 7 and the highest is almost 20 plus negative months. So a great place, which shows not only phenomenal performance year on year, but months on months and quarter on quarter. The consistency in our performance is next to none, and I don't think anyone can really come close to this. When you look at the lower bottom left side of the slide, again, consistent operations in the 4 years as per IQVIA data. So you see the market grew at 13.7 and 22. We surpassed the market growth 24.8 with a market share of 5.2. Same in 23, we surpassed the market growth, almost double the market growth there, and we gained market share almost 0.5%. 24, we grew within the market growth, and don't forget this market growth includes the GPL1 products. If you remove this, the market will grow at a lower level, but still we grew at almost the market growth and we sustained market share. 25 market grew at 10.8, we grew at 26.3, and we have gained, as I shared with you, almost 0.7% market share, and we came for the first time as number 2 in the retail market. So a very strong performance that I congratulate my team on such achievements. Portfolio transformation, we keep on sharing with you this journey of transforming from relying on specialty and niche products in 21 up to 55% of Derma, as you can see. Now they constitute 44% of our portfolio, while therapy areas like general medicine, like consumer health, like anti-diabetic are pitching in and adding at least 13, 14 points contribution into our portfolio. Very pleased with the diversification that we keep on achieving month on month, quarter on quarter, and year on year on our portfolio. Next slide. Yeah, and this is the 57 products that I told you we have it in the pipeline, and as you can see, we are strong on the ophthalmology with 15 products. Almost 13 out of them are either already submitted to Saudi FDA or about to be submitted, and a couple of products under development. Derma, again, 4 products. Maybe we are working eagerly into strengthening that such pipeline within our strategic portfolio. Gastrointestinal 6 products, consumer health 15, and hands and force cardiovascular 8 products. So well spread and well diversified pipeline, and good to see that almost out of the 57 products, almost close to 40 is already submitted or about to get submitted for approval, and another 19 is under development. Next slide. So basically, as I shared with you, 16 agreements were finalized over the course of the last quarter of 24 and the whole of 25, so almost 5 quarters, and 16 deals, which is a good achievement. We even aspire for more as we move on, and we have more on our pipeline. As you can see, diversified between biosimilar products, between ophthalmology, cardiometabolic, and consumer health and immunology. So well diversified, and these are the top 9 out of what we have signed so far. And you can see as well the diversification on the signing partners between European-based and US-based, as well as some Chinese and Japanese and others. Next slide. And this is just a snapshot on the 26 and beyond Jamjoom Pharma strategic potential initiative. So away from managing the day-to-day and the business that is giving us the 1.5 billion that I shared with you, its key highlights so far. These are things on the top that we get us busy in trying to drive on a day-to-day basis. Basically, you are familiar now with the JV that was announced last October with PIF, represented by its healthcare arm, Lyfera, to localize vaccines and biologicals in Saudi Arabian markets. And even our ambition is beyond the Saudi market, but we first need to get it right in Saudi. Manufacturing expansion, we are looking really, given the growth momentum that we keep on driving, we are looking and we keep on exploring potential alliances, acquisitions, both on getting deals like what we have finalized in Algeria a couple of years ago, acquiring full plants, or getting toll manufacturing or third-party agreements, either in our facility or we do it in others' facilities. So we're busy looking at this, and we'll hopefully come soon to you some announcements on that front. From a portfolio transformation point of view, we keep on exploring opportunities for post and licensing that I just shared with you, some examples of it, as well as strategic JVs that we look at with some of the big names, so that we can really optimize Jamjoom Pharma post reach and impact in key strategic markets and therapy areas. Last but not least, the point of strategic market localization. You know that many markets in the region are moving into giving you incentives if you show active and serious initiatives to localize yourself in these markets. So we're really exploring options as we speak eagerly in 2 or 3 of these markets to localize Jamjoom Pharma, and definitely reaping the benefits of such localizations in late 26 and beyond. And we'll give you announcement as we move on in this direction. With this, maybe I will move into our some even further focus on financial highlights by Anwar, our CFO. Down
Thank
to
you,
Amir.
Dr. Yeah, thank you, Dr. Tarek. Ramzan Karim to everyone. Thank you for joining us today for our quarter fourth 2025 earning call. So next slide, please. I am pleased to report that Jamjoom Pharma delivered an exceptionally strong fourth quarter, capping off the year with accelerated growth momentum. Our performance in quarter four demonstrated the strength of our commercial execution and increasing contribution from our strategic initiatives. Revenue for the fourth quarter grew by impressive 17% year-on-year, reaching Saudi Riyal 305 million. This growth was driven by higher volumes, contribution from new brands, and partly a positive price revision across our portfolio. The growth was broad-based across key markets and therapeutic area. Gross margin continued to its positive trajectory, reaching 61.3% in quarter four 2025, compared to 61% in quarter four 2024. This 30 basis point increase was underpinned by a favorable shift in sales mix towards high strategic brands. As Dr. Tariq mentioned, 60% of our sale was from strategic brand and ongoing operational efficiencies. Our EBITDA for the quarter grew by 22% year-on-year to Saudi Riyal 88 million, with EBITDA margin expanding by 110 basis point year-on-year to 28.8%, benefiting from top-line growth and improved operating leverage. Net profit for the quarter increased by 32% year-on-year to Saudi Riyal 68 million. This was driven by higher gross margins, disciplined cost control, and contribution from net financial income. On the next slide, we will look for the production cost. So, on the cost front, during the year of 2025, we maintained our focus on operation discipline. Cost of revenue grew at slower pace than revenue, reflecting ongoing efficiencies and the benefit of a favorable product mix. Direct production costs were generally in line with the increased manufacturing activity to meet demand. Raw materials and consumables increased as expected, supporting higher production volumes during the quarter. Salaries and employee-related costs reflected the full impact of enhanced employee reward program implemented earlier in the year. Depreciation and amortization continued at level consistent with recent quarters, reflecting our ongoing investment in Egypt and Jeddah style facility. Other operational expenses, including utilities and maintenance, were broadly in line with business activity. Our cost per unit remained stable during the year, supported by operational efficiencies and the ongoing shift toward higher value strategic brands. Turning to the right side of the slide, our operating expenses in 2025 were well managed. R&D expenses continued at steady pace, supporting our pipeline development and product readiness for upcoming launches, while selling and distribution expenses reflected targeted commercial investment behind our strategic brands and remained within plant level. General and administrative expenses remained well controlled during the year, primarily due to lower corporate sponsorship and disciplined overhead control. This measured approach to cost management, maintaining investment in R&D and commercial activities while reducing G&A, has supported our improved profitability. Through targeted high-impact spending and controlled cost discipline, we absorbed inflation and employee reward enhancement to keep cost growth below top-line growth, delivering higher margins. Moving on to the next slide, where we focus on our margin. We continue to demonstrate strong operating discipline throughout the year, which is clearly reflected in our margin expansion. EBITDA margin increased from 33.2% in the year 2024 to 35.5% in 2025. This improvement was driven by a combination of factors. Most importantly, the continued cost shift toward high-margin strategic brands, better operating leverage from higher volumes, and disciplined cost management across the organization. On the bottom line, net other income and normalized ECL provision helped offset the expected increase in OpEx, as well as lower share of profit from our Algeria JV. Despite these headwinds, we maintained focus on efficiency and delivered high profitability. What is important here is consistency. Every financial lever, revenue quality, product mix, operating discipline, and cost control work together to support a healthier profitability. This positions us well as we continue investing in strategic growth initiatives while maintaining strong returns. This performance reflects continued momentum in core operations, favorable product mix, and scale efficiencies from our expanding footprints. The consistent recovery and elevated margins profile reaffirms the strength of our business and model and execution capabilities. We will now move to the cash conversion cycle on the other slide. Uh, Lastly, our discipline focus on working capital continues to support our growth while maintaining a strong liquidity position. As of year end 2025, the cash conversion cycle extended to 256 days, representing an increase compared to 237 days in 2024. This was driven by receivable days increasing in 125 days, up from 107 days in the prior year, reflecting higher sales to institutional account with longer payment cycle. This is a deliberate strategy to secure larger market share in the institutional segment. Payable days declining to 38 days, down from 56 days due to the normalization of supplier grade terms and our ongoing efforts to strengthen strategic supplier relationship. Inventory days growing to 169 days, down from 185 days, reflecting better inventory planning, improved demand forecasting, and increased production from Egypt and Jeddah style facilities. Working capital reached to 697 million, up 17.3% year on year, largely driven by higher receivable associated with revenue growth and business expansion. We ended the year with cash balance of Saudi riyal 357.6 million as of December 31st, 2025, a significant increase from Saudi riyal 169 million at the end of September 2025 due to the cash collection towards the end of the year. This strong cash position, combined with free cash flow of Saudi riyal 458 million in 2025, provide us with ample liquidity to fund ongoing growth initiatives. With this, I would like to hand over to Dr. Tariq for his concluding remark and future outlook.
Thank you very much, Anwar. Yeah, so my last slide, then we'll take your questions. Basically, since we went public in June 2023, I think you're getting used that we share with you our guidance for at least 2 or 3 years, and we're doing the same today. So the last column on the right-hand side basically reflect 26-27 guidance, whereby we share a guidance of 10 to 12% on the revenue growth. On the EBITDA margin, 33 to 35%. CapEx, basically given our commitments and future expansion plans, we believe it will be between the 6 to 9%. And then our dividend will remain to be 50 to 60% payout, obviously subject to optimum capital allocation decisions and other investments that we'll share in full transparency as and when they come. With this, I will stop here and will invite your questions.
Thank you, Dr. Tariq, for the detailed insights. Before we open the floor for the Q&A session, just a general instruction. Please limit yourself to 2 questions. And before you ask your question, please introduce yourself. First question we take from the line of Mashal. Mashal, please mention your company name and go ahead. Mashal, could you unmute yourself?
Hi, thank you, Madhu. Thank you, Tariq and Anwar, presentation. A couple of questions from my end. So, Tariq, if you can give us a color on your view on Saudi pharma market in particular, growth potential in 2026 and beyond, and how are you viewing the market overall? And I'm seeing you the top line guidance you just gave, which is kind of shy when we compare it to the usual guidance you give in Jamjoom Pharma. Given your increased exposure to institutional market and mainly in IPCO, what is the current market looking like in terms of competition, the pricing? Are you seeing any pressure in the tendering space? And that's all from my end.
Yeah, thank you, Michelle. Yeah, no, I mean, we continue to be very positive and very bullish about the Saudi market, obviously, and we have shown you how we are driving our business in this market at the best interest of the business and the shareholders, and basically definitely performing at the forefront of such markets. So we remain positive about the market. I don't think our guidance by any means are shy. So we're basically talking about 12%, 10 to 12% growth year on year, which is something that is within the mix of markets that we operate within and the expansion. But more importantly, don't forget as well that first few years of Jamjoom Pharma journey of placing the company on the right growth momentum, we're reaping low-hanging fruits and quick wins. Today, after 4 years, as I showed you, when you double down more than double down on the top line and almost triple on the bottom line, you almost reap the most of these low-hanging fruits. So it will grow within the market or slightly higher. And we are actually here, while we think that the market will grow at 8%, collectively within our key active markets in the region, we target that Jamjoom Pharma might go up to 12%, which is 50% above what we forecast for the market in general. Saudi is no different than the rest of our key strategic markets. Our forecast there as well is between 8-9% growth for the market, definitely. We'll continue to penetrate more at definitely with strategic leverage, the institution and tender, while we continue to grow ourselves in the retail markets. And it's very balanced portfolio which Jamjoom Pharma enjoy today, Mashal, and not many can claim the same, because while we are still having the leverage in the retail market driven by the consumer health, which is basically mostly retail and out-of-pocket business, that people go to the pharmacy and ask for typical vitamin or sleep boosting or some of our other key brands in this therapy area under this category. And as well, you have the cardiometabolic and the anti-diabetic that will play pretty much well in the retail and the institution. Then it will be boosted by the biosimilars pitching in the last quarter of 26 and starting to contribute, and this will be mostly, hopefully, into institution and tender business. So our portfolio is very well balanced for the Saudi markets as well as other markets to continue to grow above the market growth, and that's what we continue to forecast. Bearing in mind, as I shared with you, that we reaped a lot of the low-hanging fruits, and we achieved a lot of the quick wins in getting the company back on the momentum and on doubling down on its top line. That it's you cannot say this will continue to be sustainable unless you really have something very strong inorganically, Mashal, which we watch the space. We will be working on this as well. Thank you for the question.
Thank you, Dr. Tariq. Next question we take from the line of Sultan. Sultan, please mention your company name and go ahead.
Hi, Mr. Tariq and the team. Am I audible?
You are.
Yes, Sultan.
Okay. Congratulations on the set of strong results. Mr. Tariq, a couple of questions from my end. One is, and this year we're seeing, especially in KSA, the growth is primarily driven by the public sector, right? So what's happening in the retail sector? Have you started to see higher competition, or is the market maturing now, especially after seeing strong low double-digit growth over the last 3 years?
No, it's not. It's actually not driven primarily just by the public sector. But the public sector is easy to show higher growth on because you're coming from a low base, as I'm sure you have noticed. So if you are coming from 100 million and you achieve 150 for a theoretical example, then that's 50% growth, but you are still at 150 million. if your retail business is 500 million and you deliver 15%, that's 75 million addition on the retail. So that's basically how you compare
Okay.
things. Yeah, so we're growing very healthy on both, but definitely, as I always shared with you from day one, that we see more potential for us because we're coming from a very low base on the institution and tender to grow higher on such area. But we still drive very strong, and I shared with you. I mean, maybe we go back to the slide if you didn't notice that this is for the first year we concluded the year in the Saudi market as number 2. Actually, the first 11 months we were number 1. We were the top player in the retail with definitely much higher growth than the rest of the market and our rivals. So that's basically our performance in the retail.
Maybe Mr. Tariq, if I can rephrase the question, what was the net sales growth in the retail channel for Jamjoom, especially in Saudi this year?
I just gave you the example. I just gave you the example. I just told you.
No, I mean, in percentage, like, did you grow 10%, 9%?
No, we showed you it's 15%. We showed it to you. Yeah, 15%.
Okay.
Yeah.
Okay, and the other question, the second question, Mr. Tariq, which is based on the growth guidance.
Yes.
Yes. So basically, you slightly lowered your guidance range. Can you? I have a little bit of unclarity on the guidance, especially when it comes what drivers are impacting your guidance. Can you give us some breakdown on how much of that guidance is going to come from your existing business, from what markets you think or will drive your majority of this growth? Of course, it's Saudi, but what other markets? And then the products, existing versus new products.
Yeah, no, definitely. Basically, the key markets that we will continue to have to focus on in 26. Basically, Saudi will continue to play a major role there, but the Gulf markets as well will continue to drive our growth. In addition to markets in North Africa, led by Morocco, Algeria, and others. Egypt definitely coming from a low base, obviously, but that's understandable. Will continue to drive our growth as well. So this will be our key markets. That plus some other export markets in Africa. That while it's still lower pace there in terms of the business, but huge potential for growth and as well very good leverage on the bottom line, given the business model that we implement there. So this will be the key market drivers. Basically, what you expect to see in 2026 is similar to the picture I showed you for 25 today, whereby you will have almost 60% coming from our strategic brands as a contributor to our growth, about 20% from established and 20% from new products, give or take. So this will be the split that you would expect to see in 26.
Very clear. One last, I'm sorry, Madhu, just one last question, Mr. Tariq, if you allow me, which is on your EBITDA guidance range. It's slightly below 2025. So my question is, do you think you're going to see some pressure in, let's say, your some of the products, or are you just being a little bit conservative at the beginning of the year?
Yeah, no, remember, it's neither. It's not being conservative. Remember what you are comparing. You are comparing actual to forecast. On the actual, last year, we started the year with 32% on the EBITDA front, or 31.5 to be more exact. And then we finished the year where you have seen us, because of the product mix and because of what we have done. So we, as an accountable player in a publicly listed environment, we manage expectation by sharing with you what we think is more than 90% within hand. And then definitely as the year evolve on us after the first 6 months, as we always share with you, we'll come back and share further on update on our guidance. So that's what we always
Very clear.
do. So we started the
Thank,
year, as I said, last year was 31, and this year we are saying 33 to 35. So that's an
thank you, Mr.
improvement.
Tariq.
Not bad. Thank you
Thank
very
you.
much.
Wishing you all the best. Thank you.
Thank you. Same to you.
All right. We take next question from the line of Ibrahim Atia. Ibrahim, please unmute yourself.
Assalamu alaikum.
Wa alaikum assalam wa rahmatullah.
Yeah, congrats, gentlemen, for the great results, and Ramadan Mubarak to everyone on the call. I'll start with the follow-up question on my colleague Sultan question. So you're beating a bit the margin by 2 to 3% or percentage points during the last 2 or 3 years. Should we apply the same variance on next year guidance as any?
والله I hope so. إبراهيم ادعنا دعوات. Definitely. Listen, that's always the aspiration.
Or
Yeah.
you're becoming less conservative.
No, we're not.
I think that's the main question we're trying to get right.
No,
You-
we're not. We're definitely never conservative. But as I said, we have to act as an accountable, a responsible partner, and we share with you what we know. I don't want to repeat. Is within hand more than because I mean. That EBITDA is a final product or a final element of many things. Your product mix that you are going to sell within the year, the supply and the ability of you to supply the highest mix with the highest margins, and so it's not only about the sales. It has tons of elements, as you are more familiar than me with this. So we give you what we believe is within hand, more than 90%. And quite honestly, if you are used that we beat expectation, that shows our responsibility and accountability as well. That we never stick to what you call a conservative approach, but we always push for more and we always try to. But when we share with you guidance and it remains as guidance, we have to share with you what we believe is within hand, more than 90% or more.
MashaAllah, tabarakallah. Great. Fair enough. Second question on the capex intensity, and I'd like to link that to LIFERA agreement.
Yes.
Can you please just confirm initially if they are linked in terms of higher capex intensity guided for the next 2 years and the LIFERA agreement or not?
Not only them, Ibrahim, and I'll stay there because I cannot disclose more, but other things that we know that we are working on, but we cannot yet disclose because it's not finalized. So with everything that we know, we are giving you the fair guidance that we believe our capex will be within over the coming few years. And remember, this is our second business cycle, as I mentioned in the earlier question, Akhi Ibrahim. In the first cycle of 22 to 24, we were reaping most of the low-hanging fruits, the quick wins, and driving existing portfolio and trying to get the best out of it. We didn't need tons of capex. We didn't need to go inorganically a lot. In this cycle, starting from 25 and 26 and beyond, it's different business model, and you will hear more of us about more inorganic approaches, like the deal with LIFERA, like other deals that we'll announce to you once we finalize in the near future, inshallah. So you will see more attempts into going more inorganically to drive growth more and to bring it more into an even more attractive fronts than the 10 and 12s and the 14s that you have seen.
Perfect. So the 6 to 9% capex
Yes.
intensity, does it include any capital commitment to LIFERA or not?
It includes the capex that we know that are for both our existing business, including our 4 existing facilities, and future projects that we are familiar and we know that it has likelihood of happening, but we cannot disclose it yet. So that's why we're giving you this guidance about what we know really will materialize or has big likelihood to materialize.
In standalone plans, new projects, or it's gonna
Maybe,
be additional
maybe
production lines to existing ones and enhancement, etc.
all the above, hopefully, Akhi
All of
Ibrahim.
above.
But we'll share with you when we finalize, and this we'll be able to disclose.
ممتاز، نتمنى
You know,
لكم
our
كل
hands on
إيه.
yes,
نتمنى لكم
publicly
كل
traded company.
نتمنى لكم كل التوفيق،
تسلم.
يعطيكم العافية. Thank you so
دعواتك
much.
حبيبي، تسلم تسلم، الله يكرمك.
Thank you, Ibrahim. Since we do not have any questions through the hand raise button option, I'll read out questions posted in the chat box. There are two questions. One is related to the distribution. So this question is from Yakub. So question is, are you seeing a structural shift in KSA from traditional distributor towards wholesaler as the primary channel to pharmacies? If yes, then what is the impact on working capital and margins?
I mean, if the question is about more concentration on chain pharmacies and whatever, definitely there is a trend that is not happening today, but it's evolving for the last few years and intensifying even with Wasfati being limited or being focused into certain chain pharmacies and whatever, which is adding to the weight that these guys are having. Would that mean that the typical classic distributors or distribution model will disappear? I don't believe so. I think both will continue to work hand in hand. Yeah, you are seeing every now and then attempts that people are stepping into each other's shoes and trying to do everything. So chain pharmacists trying to be a distributor at the same times, and vice versa. And I mean, I think this will take its time until it settles, and people will hopefully focus on what they can do best and best. And most. So we believe that distributors and the distribution channel will continue to be similar to where we are. Maybe you will see another wave of consolidation. We expect this. Hopefully, so that the market can become more focused. And yes, chain pharmacies will continue to try to gain more front business and more partnering business and whatever. But I don't think this will have in the near future any change in the Saudi business models. None of them will step into the other shoes or will be able to replace the other.
Thank you. Second question has already been answered in the chat itself. I'll read out the other questions which just came up. Question is from Faisal, and the question is related to the Optha revenue in Q4. What was the reason for decline in Optha revenue despite ongoing investments in the products?
Yeah, I mean, it's, I mean, we as I always repeat, we don't manage our business month by month or quarter by quarter, but we look at it holistically over the overall year. As I give the example earlier, if you look at the Saudi Arabian market, which is one of our key markets for our ophthalmology line in Jamjoom Pharma, we closed the year. The market, the therapy area, grew at 16 or 17%. We grew at 23%. And obviously we gained share, and we did better than the rest of the market, which consolidated our leadership. So that's an example I give you about our OFSA performance. A quarter can have, as I mentioned in many earlier earning calls, can have fluctuations in ordering patterns, manufacturing patterns, supply patterns, and that's why we manage the year in a full 12 months as opposed to month by month or quarter by quarter.
Clear. There's one more question in the chat box. This is related to your institutional sales exposure. What was the percentage of total revenues from institutional sales in 2025 versus 2024, and what is the outlook on institutional sales?
So we showed already that the institutional, it's mainly actually most of our institutional business is happening in Saudi and the Gulf. The rest, some other markets have tender and institution, but it's in the grand scheme of things relatively small compared to Saudi and the Gulf. Saudi constitute almost 85 to 90%. And Saudi, as we showed you, grew last year by 56%, the institution business. If the question is, do we expect similar growth this year up to 56%? We're not forecasting for this. We're forecasting for less, but we're forecasting for strong growth. Hopefully, the market can surprise us and we can grow at a better term, because we didn't fully forecast for the 56 that we had in 25, but we had extra business and we generated extra business. Hopefully, we can do the same in 2025. But we're still very, as I said, bullish and positive about penetrating and gaining more share and gaining more better ranks and whatever in the institution and tender, especially with the pitching in of the biosimilars and the anti-diabetic portfolio and some of our other more specialized portfolios.
Clear. Before we take our next question from the chat box, just a reminder to the participants, if they have a question, they can use the hand raise button or the chat box. And the participants who have already asked their question, kindly lower your hand. And if you have a follow-up, you can come back in the queue. All right, as we do not have questions through the hand raise button, I'll read out a few questions which are posted in the chat box. The question is from the line of Masroor, and it's related to the product pipeline. So out of the 57 product pipeline, what are you expecting to be launched in 2026, specifically first half of 2026? And were there any price hikes in quarter 4 2025? And are you expecting any price hikes in 2026?
Yeah, thank you for the question. So basically on the first portion of the question, which is how many products, I think we share with you guys over the last few years, and this year is not going to be an exception, that we always target to launch something between 6 to 10 products year on year. And these launches, I'm talking about our key inception markets, really, because we do a lot of other launches, don't forget, in other markets, but that's catching up. Because as you know, Saudi being our inception market, we have to register here, we have to launch here, and then after some time, we are able to submit files and launch the same products in other markets. So in Saudi, we will continue to target 6 to 10 launches, as we did in the last few years. But we continue to catch up with other launches in the rest of Gulf markets and North African and Egypt markets and others. Did we have price increase in 2025? Yeah, but relatively speaking, it was just, I would say, 1 to 1.5% of our total revenue. So it wasn't that much, but it was good enough, and it came from a mix of markets, not only from the Saudi markets. Because as you know, I mean, when we get a price increase in Saudi, other markets catch up as you move on in the following quarters and years. So we're getting price increases in the Gulf, we're getting some price increases still in Egypt to catch up with the devaluation, and some other markets as well. So that netted into the 1.5% contribution of our total revenue coming from the price increase.
Thank you. And there are a few more questions. I think you have already answered the inorganic growth part. The other questions are related to your region-wide margins. Would you be willing to disclose your margins by countries? I believe that is the question. And second is, what is your market share in consumer health and general medicine?
What is the what? Sorry?
What is your market share in consumer health and general medicine? Of the total consumer health, how much is your share?
Yeah, sure. So basically, the first portion of the question, I think it's we as Jamjoom Pharma, as corporate, we share with you in full transparency our EBITDA margin and our net profit margin, and I think we'll continue to do so because that's our basically commitment and obligations to share this. Market by market can fluctuate, as you know, but it doesn't really tell you a full story because a market can have a higher margin but very low volume, so it will not really be significant in moving the needle for you. And but we share with you, and you can tell, for example, that the major markets that constitute 60, 70% of our portfolio, if they don't pitch in and play within the margin that we share with you, we will not be able to achieve such margins. But we'll continue to show a corporate level EBITDA and net profit and top line margin and growth as we are committed to do. In consumer health, as I always share with you, it's one of the I told you that our overall business has more than doubled between 21 to 25. Our consumer health alone have almost quadrupled between 21 to 25. So that's a business that we are very bullish about. And it's really leading the way. So we are becoming the number one pure consumer health company in Saudi Arabia with huge growth above the market. And our market share is within the 25s and 30s at all times. Basically, driven by the likes of our melatonin, the sleep boosting, the lines of Omega, the lines of ProLife, which are probiotics, as well as the multivitamins that we have, and some other vitamins specific like vitamin D and other portfolios. So these are the key products that really contribute to our consumer health. But that's a therapy area that we're very bullish about, and we expect once we launch it in other markets, because don't forget, 90% of these businesses currently taking place in Saudi Arabia. Once we really strengthen our this portfolio and we launch it strongly into other key strategic markets, we believe that this portfolio has all the potential to lead our growth momentum for many years to come. General medicine, we are number one as well there with our portfolio there that ranges from anti-infectives into some other specific products for treating muscles like muscle relaxants and some other areas. So it's basically a mix of products, but we are pleased that we are really growing massively in this general medicine portfolio, and we are leading the way as well in terms of the rank in the marketplace.
Very clear. Last question. This is from the line of Sultan, and he has posted his question in the chat box. Out of your 57 products, in terms of molecules, how many are new molecules?
The 57 products are all new molecules, new to Jamjoom Pharma. They are not new to markets because remember, we are a branded generic company. So all these products are referencing original products in the marketplace. So it's new to Jamjoom Pharma, mostly and hopefully will be new as a first or second generic, which is our strategy into the marketplace once we launch it, majority of them, but definitely they are not new to the market. So that's the 57. Don't forget that our pipeline doesn't only constitute the 57 because I showed you a parallel line that we have lately over the last 18 months or so became very active in driving it, which is the business development licensing in opportunity from outside. You can add this as well. So all the 16 deals that I shared with you, you add this to the pipeline, and majority of these products will be launched within the coming 9 up to 36 to 48 months. So that adds as well. So you cannot look at our pipeline only within the 57, but basically when you add the 16, you're talking about 73 products or more that is within our reach to launch over the coming few years, which is a very good place to be. And we'll continue the efforts in further strengthening such portfolio as well.
Very clear, Dr. Tariq. So that was our last question. And if you have any closing remarks, you can share those. And after that, we can end the call.
Thank you very much. So thank you all, as always, for being great partners and for always keeping us honest with your questions and tracking our portfolio and our growth. And as you can see, I'm surprised that no one of you mentioned this, but in the last quarter this year, we grew better than any previous last quarter over the last years. This is listening attentively to you and trying to balance our quarters in terms of sales as well. So that actually was one of the key things that we have taken and we listened to you and we implemented. So we allowed a better spread over the four. Still, our fourth quarter was our lowest quarter in terms of total sales, but higher by 17 or 18% than the last quarter of 24. And that's basically listening to you guys and trying to balance out over all the quarters. So you didn't notice it, but I picked it and I'm sharing it with you. And I thank you for keeping us honest. And I'm glad that we listened to you as well and we have done it. And I don't regret it and we'll continue to do it over the coming few years. So I thank you. I wish you all Ramadan Kareem and inshallah watch the space for a lot of good news, not only on the results, but as well on our key strategic initiatives moving forward in 26 and inshallah.
Thank you, Dr. Tariq, and also Mr. Anwar. Wish
Thank
you all a
you.
good day. Yeah. Thank you.
Same to you.